All right, so today we are going to start the audit planning. And in the last lecture, we discussed some basics of audit. And if you remember, we started with the background of the audit, that the background of the audit is the agency problem. That the directors are running the company on behalf of the shareholders. Shareholders are sitting outside the organization. So that is why they need some independent person to check the financial statement on their behalf and tell them whether the financial statement gives the true and fair view. We discussed that true means the information is factual and confirms with reality. We discussed that fair means that information should be unbiased and impartial and should depict the commercial substance. And then we move towards the objective of the external audit, in which we discussed that the objective of the external audit is to give the reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error, in prepared in all material respects and in accordance with relevant financial reporting framework. And I told you in the next lecture, we'll be continuing from this concept. We'll be moving further, but we'll continue from this concept that in the external audit, the auditor has to make sure two things to the shareholders. Objective of the external audit. So we discussed two things. First of all, that financial statements are free from material misstatement. So the first assurance the auditor needs to give to the shareholder is that the financial statements are free from material misstatement. The second thing was that financial statements are prepared according to the relevant financial reporting framework. So this is what we discussed in the last lecture, and we discussed that in quite detail. Now we'll be moving further. Make sure you just remember what we said in the last lecture. So the auditor needs to give the reasonable assurance to the shareholders regarding what? First thing, financial statements are free from material misstatement. And the second thing is the financial statements are prepared according to the relevant financial reporting frameworks. So that means we have to give the reasonable assurance regarding two things. Now again, why we are doing the audit? Why there is a need of an audit? Why the shareholders are not directly relying on what the directors are saying to them? Because of the agency problem, because of the lack of the trust. Because it is possible that the directors may have manipulated the financial statements. It may have the creative accounting in it. It may have the window dressing in it. The directors may have exaggerated the financial statements. So that is why the shareholders need some independent person to audit the financial statement, because they have some concerns regarding the financial statements, and those concerns are related to the under or overstatement. Maybe expenses are understated, profits are overstated, maybe assets are overstated, liabilities are understated. So they have the concern regarding the financial statement. That is why they need some independent person. So when the auditor is doing the audit, there are two risks. While doing the audit, there are two risks. The first risk is financial statement may contain material misstatement. And we discussed in the last lecture, material means something which can affect the decision of the user of the financial statement. Misstatement means anything which is not according to the standard. So material misstatement means significant errors and omissions which can affect the decision of the user of the financial statement. So when the auditor is doing the audit of the financial statement, while doing the audit of the financial statement, there are two risks. The first risk is that the financial statement may contain a material misstatement. That means a possibility that the financial statement may have a material misstatement. So you have to keep this thing in your mind. You have to keep this thing in your mind that the financial statement may have a material misstatement. Because otherwise you will not be skeptical. If you have something in your mind from the very start that everything will be fine, then you won't be able to identify those material misstatements. So there's the first risk that the financial statement may contain a material misstatement. What is the second risk? Auditor may not detect the material misstatement. The first thing is that the financial statement may contain the material misstatement. The second risk is that the auditor may not be able to detect the material misstatement. So if there are material misstatements in the financial statements and the auditor is not able to detect that, then what are the consequences? What is the impact? If there are material misstatements and the auditor didn't detect that, then the auditor will be saying everything is fine. Financial statements are true and fair. And this will not be right thing because obviously there were material misstatements and you didn't detect that. So as a result, auditor may give the incorrect audit opinion. And this concept is known as audit risk. Or simply, risk in the audit is that the auditor may give the incorrect opinion. Now you see, everywhere I have used this term may. Financial statement may contain a material misstatement. Auditor may not detect the material misstatement. As a result, the auditor may give the incorrect audit opinion. Because at the planning stage, which is the first stage of the audit, we are not sure whether this is the case actually. Because planning stage is something which is the part of the interim audit. Now, interim audit is actually the audit which takes place before the year end. Interim audit is the audit which takes place before the year end. We divide the external audit into two stages: interim audit and final audit. You did this thing in F8 exam. We divide the external audit into two stages: interim audit and final audit. So the audit that takes place before the year end is actually the interim audit. That means some activities will be done before the year end, because if we keep everything after the year end, then there will be too much time pressure on the auditor. So they won't be able to do the planning, they won't be able to do the testing of the internal controls. So they keep these things in the interim audit. Interim audit, we do not have the financial statements. So in the interim audit, we do not have the financial statements. So we are just doing the audit planning. So while doing the audit of the financial statement, there are two risks. The first risk is that the financial statement may contain a material misstatement. The second risk is that the auditor may not able to detect the material misstatement. And as a result, the auditor may give the incorrect opinion. This is known as the audit risk, or the risk in the audit is that the auditor may give the incorrect audit opinion. Now, obviously, the auditor needs to reduce this risk. The auditor should reduce this risk, reduce the audit risk. Now, this risk is actually coming from two sources. The financial statement may contain a material misstatement. Now, we cannot do anything regarding this risk because we have not prepared the financial statements. Financial statements are prepared by the management. So, this risk cannot be eliminated because we can only eliminate this risk once we ourselves prepare the financial statement, which is not possible because in the audit, it is the responsibility of the management to prepare the financial statements. So this risk needs to be reduced. Now, audit risk is coming from the two sources, as I said. Financial statement may contain a material misstatement. Auditor may not detect material misstatement. So can we do anything regarding this risk that the financial statement may contain a material misstatement? We cannot do anything. We cannot eliminate this risk. Because financial statements are prepared by management. Financial statements are prepared by the management. Auditor may not detect the material misstatement. Now, this is something which is related to us. This is our risk, our own risk. So we can fix this risk. We can reduce this risk by using competent staff, spending appropriate time on the audit client, being skeptical, carefully determining materiality level, etc. So again, I'm going to link this thing what I have said. So the first thing is that we are at the planning stage, which is done at the interim audit. Now, the objective of the external audit is to give reasonable assurance that financial statements are free from material misstatement and prepared according to the standards. So when we are doing the audit, there are two risks. Financial statement may contain a material misstatement. Obviously, there's a possibility. That is why we are doing the audit. If the shareholders were so sure regarding the financial statement, then there would be no concept of the audit. So the first possibility is that the financial statement may contain the material misstatement. The second is the auditor may not detect the material misstatement. So if there are material misstatement in the financial statement which remain undetected by the auditor, then the auditor may give the incorrect audit opinion. This concept is known as the audit risk. That means the risk in the audit is that the auditor may give the incorrect opinion. So what if the auditor is giving the incorrect opinion? This will be the negligence. This will be professional negligence at the auditor's end, and obviously this will lead to the litigation. They're going to sue you for incorrect opinion. So that is why the auditor needs to make sure that they are giving the correct opinion. Now, from where this risk is coming from, either the financial statement may contain a material misstatement. So we cannot eliminate this risk because this risk is coming from the management because they have prepared the financial statement and we have not prepared it. Auditor may not detect the material misstatement. Now, this is something which is related to us. We can fix this risk. We can reduce this risk by using competent staff, spending appropriate time on the audit client, being skeptical, choosing the sampling methods properly, materiality level properly. So we can do a lot about this thing. But what about this risk that the financial statement may contain a material misstatement? What we have to do with this? Obviously, we should do something regarding that. Financial statement contain a material misstatements. So regarding the possibility that the financial statements may contain a material misstatement, the auditor should. So regarding the possibility that the financial statement may contain a material misstatement, the auditor should take the detailed understanding of the entity. Which is the main thing that the auditor does at the planning stage. Regarding the possibility that the financial statement may contain a material misstatement, so this is a risk. What we can do regarding this thing is that we should take the detailed understanding of the entity. Now, why we will be taking the detailed understanding of the entity? To identify those areas which may have the material misstatement. Now, like you probably have seen the dramas or movies in which there's sort of investigations and suspense. So, like for example, if you have watched a drama or movie in which there are some investigative officers and they are investigating a murder or a criminal activity, first of all, they identify the suspects. Like for example, if they are investigating a murder case, what they're gonna do, like first of all, they identify a suspect. So there will be a person, a suited booted person, and he comes and he says to his team that I need this guy's bank statement, I need this guy's mobile records, I need this guy's social circle, friends. Because the first thing they're gonna do is to identify the suspect. Obviously, they cannot investigate the whole world because there is a possibility that anyone from the world can be involved in this murder case. But it is impractical, this is impossible that you investigate the complete world. So what you do at the first place is you identify the suspects. Now, suspects are those people who may be involved in this murder. So how they actually identify those suspects, they look at the financial transaction that this guy was doing financial transactions with those guys, and this guy was actually talking to those guys in his uh, mobile directory. We have seen that this guy was doing calls to those guys, etc., etc. Similarly, if you apply the same concept over here, the financial statements have many heads. Like they have the revenue, there's a cost of sale, and there's a gross profit, and then administrative expenses, distribution cost, and then you have the finance cost, and then taxation, and then profit for the year, other comprehensive income. You go to the balance sheet, you have assets, non-current assets, current assets, and in the non-current assets, you have the PP, intangible assets, investments in associates, goodwill. There are so many things. And if you talk about each head, then there are a lot of transactions going on in each head, like the revenue, There may be millions of sales invoices, because if you talk about the big companies, they have millions of sales, so millions of sales invoices. So again, it is impractical that we check each and every sale invoice. If you talk about the expense, there will be millions of expenses, and every millions of expenses will be having their own relevant records. So it is impossible that we can check each and every document. So that means, first of all, we have to take the detailed understanding of the entity. And by taking detailed understanding of the entity, we have to identify those areas which may have the material misstatement. Because first of all, we identify the suspects. So first of all, we identify those areas of the financial statement which may have the material misstatement. And then later on, when we move towards the testing stage, because now we are at the planning stage, later on when we move towards the testing stage, then we will be able to test those things. Like, first of all, you identify the suspects and then you start investigating those people. So same over here. First of all, you identify those areas which may have the material misstatement, and then you start doing the testing on those areas. Now, okay, it's fine. We have said this thing that first of all, you have to take the detailed understanding of the entity, because it will help you to understand those areas which may have the material misstatement. Now, what is actually the linkage? What is the linkage of taking understanding of the entity with the identification of material misstatements? Let's take some examples. Now, what is the linkage of taking the understanding of the entity? How these two are related? How taking the understanding of the entity can lead to the identification of material misstatement? How these two things are linked? Now, let's take some examples. For example, you were taking the detailed understanding of the entity. For example, you are doing the audit of the Samsung, and they sell mobile phones. They sell many things. Let's stick to the mobile phones, cell phones. So you are auditing the Samsung and they sell mobile phones, and they told you that we sell the mobile phones and we give warranty on our phones, that if something goes wrong, you can bring those phones to us and we're going to repair it or replace it. So this is something they told you, that they sell mobile phones and they offer warranty to their customers. If something goes wrong, they can bring those phones and the company will be repairing or replacing those phones. Now, why they are offering the warranty? Because there is a possibility that something may go wrong, and you know, the electronics thing, they can not be trusted because anything can go wrong anytime. So like if I'm spending $1,000 on a phone, I need some assurance from the company that if something goes wrong, then they will be actually taking care of it. Because otherwise I'll not be feeling comfortable in spending $1,000 if the company is not taking any responsibility. So if they say, give us the $1,000 and we do not take care of it, if anything goes wrong, that is your responsibility, then I'll not be buying the phones, because 1,000 is a significant amount. I have to take care of it. So in order to give the assurance to their customer, to give the confidence to their customer, they offer the warranty. And they know that these are the electronics products, something may go wrong. Even they have tested those things 1 million times, still there's a possibility that something can go wrong. You experience those, they have experienced those things in the past. You remember the Note 7 when they launched it, there were the explosions in it. and then it leaded towards the universal recall. All over the world, they sold the phones and then they recalled from the customer and they paid the customers, they paid back the customer their money. And it was ended. No Note 7 existed now. So Samsung mobile phones, they offer warranty. Now, when they are offering the warranty, obviously it is a possibility that some phones may come on the warranty for repair or replacement. So outflow is probable. Now, outflow is probable because if something goes wrong, those phones will be coming for repair or replacement. And if the company is repairing it, there will be repair cost. If the company is replacing it, there will be the replacement cost. So outflow is probable because if something goes wrong, they have to repair or replace it. Now, the accounting treatment for this is that they should record the provision because the outflow is probable. You started this thing in SBR and the F7. Record the provision according to IAS 37. Now, what is the risk? There is a risk that provisions may not be recorded or recorded at incorrect amounts. That means their accounting estimate may not be right because, for example, they are expecting repairs only and all the phone came for replacement. So repair and replacement have a different cost. Right now we are at the planning stage. We do not have their financial statements. So once they told us that they sell mobile phones and they give the warranty to their customers, then at that time, we first of all brought this thing in our mind that some phone may come for repair or replacement. As a result, their outflow is probable. They should record the provision for it according to IAS 37. The risk is that the provision may not be recorded. So this is first suspect. This is the first thing we suspected, that they may not have recorded the provision. Right now, we are not sure about it because we have not seen their financial statements yet. But we will write this thing with us as a suspect, risk of material misstatement. Now, this suspect is actually the risk of material misstatement or the financial statement risk. There is a risk that the provision may not be recorded. We are not sure. We have not seen their financial statements. We have not checked their provisions yet. But this is a suspect. So this is the first example. They just told us that they are offering warranty. And from that point, we just identified the risk of material misstatement related to provisions. Now let's take another example, moving further. The same company told us that they have done research and development and they have spent $10 million on it, for example. They told us this thing. Now, they have spent $10 million on the research and development, and we know that research should be expensed out. Research costs should be expensed out according to IAS 38. And development should be capitalized if the criteria is met. and this is in accordance with IAS 38, intangible assets. So they told us research and development, okay, obviously they have spent a huge amount of money on it. Research should be expensed out, development should be capitalized if the criteria is met. Now the criteria, we know that probable economic benefits, intention to use or sell, resource available, ability, technical feasibility, expense can be measured reliably. Now once they have told us, now we'll be bringing the risk in our mind. There is a risk that research may be capitalized. The treatment is that it should be expensed out, so it may be capitalized, or the development does not meet the criteria, but still capitalized. We are not sure what they have done, but because they told us that they did the research and development, so we just brought a risk in our mind that they may not have recorded it correctly. Research may be capitalized, or the development does not meet the criteria. They may have still capitalized it. So that means now we have another risk of material misstatement in our risk that we need to test when we go to the testing stage. So they will keep us telling different things, and we will bring the risk in our mind. For example, they say we have done financing this year, financing this year, and we have raised finance through issuance of equity shares, and we have also issued the debenture or loan notes. So now they have told you this thing that they have done financing this year, and financing is done through two sources. They have issued the equity shares and also a debenture. Now you know that, okay, the accounting treatment for issuance of equity share is that they should record the cash, credit share capital, and credit share premium. They have to split this between the capital and the premium. So up to the par value, it should go to the capital, and above this, it should go in the premium. Debenture has completely different treatment. So according to IFRS 9 financial instruments, this should be recorded as the financial liability at amortized cost. And interest cost is recorded in the profit or loss. So they just told you the thing that they have done the financing from two sources, equity finance and the debt finance, which is the debenture. And you brought the treatment in your mind that actually there are two different treatments for the equity and the debt. Now there's a risk that the equity may not be split correctly between share capital and premium. The second risk is, and the debenture may not be recorded at correct amortized cost because there is a working for it, or incorrect finance cost may be recorded. Now, obviously, you are not sure regarding this thing, but this is just a risk that you had in your mind now, and you will be checking it later when you are doing the testing. So this is the linkage of the understanding of the entity with the risk of the material misstatement. That means you take the understanding, you bring accounting treatment in your mind, and the financial statement risk, and what can be the risk in the financial statements. So this is the linkage of understanding the entity. So you can take a lot of examples. I have given the examples in the notes as well, but I've given the completely different examples over here. So this is the linkage of understanding the entity with the risk of the material misstatement. All right, now we'll be discussing the components of audit risk. Now we'll be discussing the components of audit risk. All right, so audit risk, first of all, is the risk that the auditor may give incorrect audit opinion. This is known as the audit risk, or risk in the audit is that the auditor may give the incorrect audit opinion. This is the audit risk. It has three components. First of all, inherent risk. Second one is control risk. The third one is detection risk. So inherent risk, control risk, and detection risk. Now, inherent risk is risks likely to occur in the client's financial statements due to its nature. Control risk is entity's internal control system may not detect material misstatement. Detection risk is that the auditor's procedure may not detect material misstatement. Now, first of all, you see that the first risk is the inherent risk. And the definition of inherent risk is, the plain definition, is risk likely to occur in the client's financial statement due to the nature. The control risk is the entity's internal control system may not detect material misstatement. So the inherent risk is due to the nature of the entity. The control risk is due to the system of the entity. In both of these two risks, the auditor has nothing to do. That is why these two risks are known as the financial statement risk or risk of material misstatement. Because inherent risk is the risk due to the nature of the entity. Control risk is the risk which is related to the system of the entity. In both of these risks, there is no involvement of the auditor. If you talk about collective risks, inherent control and detection altogether, then it is known as the audit risks. Okay, so first of all, we need to understand what is inherent risk. Risk likely to occur in the client financial statement due to its nature. Let's take some examples. Inherent risk. For example, you are auditing a construction company. Which have long-term contracts. So you are auditing a construction company which have the long-term contracts, and you know that according to IFRS 15, you studied that according to IFRS 15, the revenue related to the construction contracts should be recorded based on the stage of completion. Revenue should be recorded based on the stage of completion. Because they have the long-term contract which is for 2 years, 3 years, 4 years. So according to IFRS 15, the revenue which is related to the construction contract should be recorded based on the stage of completion. Now the risk is, there is a risk that revenue may be immediately recorded. Rather based on stage of completion, or incorrect stage of completion may be determined. Now this risk is specifically related to the construction company because this is due to their long-term nature of the contracts. If you talk about the company which is selling the beverages, they are not having this risk. If you talk about the company which is selling furniture, they do not have this risk. If you talk about the company which is selling fashion goods, they will not be having this risk because this risk is pertinent. This risk is relevant to the construction company only because they have the long-term contracts. So inherent risk likely to occur in the client financial statement due to its nature. Every time when we are auditing the construction company, we'll be having first risk in our mind that their revenue may be incorrectly recorded because it should be recorded based on the stage of completion. So this is inherent risk. Risk likely to occur in the client financial statement, and every entity have the different nature. For example, this was the example number 1. Let's take example number 2. For example, you are auditing a company which makes beverages. Or for example, fizzy drinks. Now you know that they are actually making beverages, and this is inventory. Inventory is subject to expiry because obviously these food items have a particular expiry. Now, there's a risk that some inventory may be expired and not be written off. They have not written it off. Still, that is part of the inventory. So this risk is not related to the company which is selling furniture, because furniture do not have the expiry just like the food, although they have the other risk like the changes in the designs, or for example the fashion changes. But still you can see that furniture is much different, because still there are people who still buy the same design every year because they likes such designs. So there is a risk that some inventory may be expired, but fizzy drinks, if they get expired, no one gonna drink that. So there is a risk that some inventory may be expired, like because they didn't sell it, and now it is still part of the inventory and not written off. So this risk is related to the beverages company only. Similarly, this expiry risk can be relevant to the pharmaceutical companies. They have the medicines, and those medicines may get expired, and still that is part of the inventory. When you talk about the fashion industry, there is a risk of obsolescence, like the fashion changes, like you see every year there's a different fashion. So when they have the new articles, the old get obsolete, and they have to sell it in the discounts. You can see up to 80%, up to 75%. So sometimes even their NRV becomes less than their cost. So it should be written down to the NRV. So risk likely to occur in the client financial statement due to its nature. So this is inherent risk. Now control risk. Control risk means that the entity's internal control system may not detect the material misstatement. When there are risks in the financial statements, first these are being detected by the entity's own internal control system. And then there is the auditor who actually detects that. In the organization, there are different levels of the finance function. There's a finance director, financial controller, senior accountant, junior accountant, chief financial officer. There are many designations. So finance director, and then financial controller, and then manager accounts, and then senior manager, and then junior manager. And then we have the accounting technicians. So these are the functions in the organization of the same finance, accounting and finance. So why there is a finance director? Why there is a financial controller? Because everyone has their own responsibilities. When you talk about the finance director, they do have the supervisory role basically. Whatever is being done by the financial controller, by the manager accounts, or the senior manager or the junior manager is being reviewed by the finance director before it enters the financial statements. Because they are checking whether they have done the correct accounting treatment. Because if something is done wrong by the senior accountant, it will be detected by the financial controller or the finance director himself before it gets into the financial statement, before it gets published. So what if there is no financial controller? What if there is no finance director? Then there will be no one to review the integrity of the financial statement. And if any treatment is done wrong, it will directly go to the financial statement. This is control risk. If there are loopholes, if there is no check and balance, if there are no hierarchies, then this is a control risk. Similarly, if they have the new accounting systems and they are not trained to use that, then again they may perform the incorrect accounting treatment. This is again the control risk. Detection risk is that the auditor's procedure may not detect the material misstatement. Now, if there is incompetent staff, junior staff, they're not spending appropriate time on the audit client, their sample size is not correct, their materiality level is not chosen correctly, then due to the auditor's negligence, the auditor's procedure may not detect the material misstatement. This is known as the detection risk. So the first two, which is inherent and the control risk, because inherent is due to the nature of the entity, control is due to their system. These two is known as the financial statement risk and the risk of material mistake. But if you talk collectively, if you talk altogether, then this is known as audit risk, because first there is inherent risk. That means the risk likely to occur in the client's financial statement. It is then detected by the entity's own internal control system, which is control risk, if they remain undetected. And then if the auditor even didn't detect that, then that will be the audit risk. So inherent risk is the risk likely to occur in the client financial statement. First, it is detected by the control. And then if it is not detected by the entity's own internal control system, that is known as the control risk, then it is being detected by the auditor. If the auditor's procedure may not detect that, then that is transformed into the financial statement and the auditor may give the incorrect opinion. This is known as the audit risk. But in the exam, when you have this question, remember this thing, we have exam focus point. We will not be identifying inherent control or detection risk. In the exam, there's no need to differentiate that this is inherent risk, this is control risk, and this is detection risk. You are just supposed to write audit risk. Now, how audit risk is being written, see the above examples. Like we did here. So they will be telling you that the entity has done the financing this year, they has issued some equity shares as well as the debenture. Now I'll be writing according to the standard, issuance of equity shares should be divided into share capital and share premium. Debenture should be treated as per IFRS 9 and should be recorded as financial liability at amortized cost. Interest cost should be expensed out. There is a risk that equity may not be split between correct share capital and share premium, and the debenture may be recorded at incorrect amortized cost. So you see, I have not used any inherent control or detection risk over here. I'm just writing the risk. Similarly, in the previous example, research should be expensed out, development should be capitalized. There is a risk that research may be capitalized or the development may not meet the criteria. We didn't use any inherent control and detection over here. Similarly, according to the IS 37, if the outflow is probable provision should be recorded. There is a risk that incorrect provision may be recorded. So we have not even used the term inherent control and detection. So that was just to explain you the components of audit risk. There's no need to write in the exam that this is inherent, this is control, and this is detection. If you're doing that, if someone is telling you to do that, you are putting yourself in the trouble, because sometimes you may write it wrong. Like you are writing control risk as inherent risk. We are not required. Even the examiner has not even written a single risk like that. You can see the past papers for the reference. So you have to make sure that you are actually writing the correct thing in the exam regarding the financial statement risk or the audit risk. So what is the difference between audit risk? If you talk about all these three components, inherent control, detection, audit risk. What is financial statement risk or risk of material misstatement? The first two, inherent risk and the control risk. But for the exam point of view, this is completely the same because we have to write in the same format. So how are we going to write it in the exam? First of all, we'll be writing the case study line. you start with the heading first in the P7. Like if you're writing a financial statement risk, make a heading. For example, provision. Write the case study line because it will make sure that which risk you are writing, because in the exam there may be 2 to 3 risks related to provision. So which provision you are writing? For example, warranty provision, there may be redundancy provision, there may be restructuring provision, which provision you are writing. And then you will be writing accounting treatment. Then the risk and effect on the financial statements. Like for example, research should be expense out, development should be capitalized. This is the treatment. There's a risk that expenses may be misclassified. That means research may be capitalized or the development does not meet the criteria but still capitalized, resulting in the understatement of expenses and overstatements of assets. So this is how we are going to write in the exam. Effect on the financial statement means resulting in the understatement of expenses and overstatement of profits.